Hello everyone, we are Group 5. Our project title is Tesla's Optimus robot. There are five parts in our report. This report will evaluate the financial viability of Tesla's Optimus robot project through data analysis and informed assumptions based on company-provided financial information. Description: Tesla is currently focused on the development of a humanoid robot called Optimus. This humanoid robot is designed to tackle a wide array of tasks across various sectors, including manufacturing, logistics, and home assistance. The project presents a significant engineering economic challenge, particularly in the successful launch of this new product. This requires not only advanced technology but also strategic planning to ensure it's embraced by the market and achieves financial viability. Tesla financial indicators. They have reasonable debt management, but challenges in short-term liquidity. The need for more efficient asset utilization. The return on equity is 3.50%. Price to earnings ratio is 400 and 3.84. Alternative A is industrial-grade Optimus, which has heavy-duty robust design and the price is about 20,000. Alternative B is Agile Optimus, which has lightweight Agile design. The price is approximately around 90,000.
Hi, I'm Minrui. I will be covering the cost and benefit comparison between alternative A and B. I will start with a breakdown of the main cost component and then show how each option performs in terms of long-term project benefits. Looking at the chart, we can see some key cost differences between two options. Alternative A starts with a slightly lower initial capital cost, but its operation and maintenance costs are much higher, reflecting its higher production scale and output. In contrast, alternative B is more conservative in scope, which results in lower cost spending. Depreciation is slightly higher for B, but is different in manner in the overall cost structure. A also pay more tax which reflects its higher net income. Meanwhile, B faces a heavier and increasing lower repayment burden over time. So overall, while A is more expensive to run, those costs are tied to higher productivity and revenue capacity. Now, moving to the project benefits, as you can see from the stack bar chart, alternative A generates significantly higher revenue every year. It starts strong from year one and grew steadily to reach 40,000 by year 16. In contrast, the B's revenue is stable but lag behind, reaching only 13,600 in the final year. Both options also recover value at the end of the project through salvage and working capital recovery, but even with this added, A still leads in cumulative benefits. This shows that A not only scales better but also offers strong long-term returns on investment. That's the comparison of cost and benefits. Next, Zexin will talk about viability indicators and the cash flow.
We first calculated the net income of alternative A and B. According to the tables, alternative A delivers significant early-stage profitability due to low per-unit cost and rapid scale-up, resulting in steadily increasing net cash flows. In contrast, B has slower initial growth and higher depreciation, resulting in delayed cumulative profitability. This distinction highlights A's superior early cash generation. and faster capital recovery. Then to get the cash flow of both alternatives, we calculated indicators in the tables and compared the two alternatives. A's initial outlay is slightly lower than B, and B requires more working capital and borrowing, leading to a higher repayment pressure. Although early cash flows are comparable, A generates significantly higher net cash flow in year 16. Overall, A demonstrates a stronger return and is financially more favorable. Then we calculated the viability indicators. According to the tables, with a significantly shorter PB, alternative A ensures faster capital recovery and reduced financial risks. Its higher BCR indicates superior economic efficiency, while the greater NPV reflects enhanced profitability and long-term viability. Additionally, the lower LCC per unit underscores better cost effectiveness over the project's life cycle. These advantages establish A as the optimal investment choice, offering a balanced and superior risk-return profile.
Today, I'll briefly present the risk assessment for Tesla's Optimus project. First, let's look at the key qualitative risks identified for both alternatives. These include cost overruns, especially for Alternative A due to complex industrial design, and regulatory challenges that are more severe for Alternative B given global compliance requirements. Technology failure and market demand uncertainty are common risks, but have different impacts. Alternative A faces higher risks from cost control and industrial uptake, while Alternative B is more sensitive to labor shortages and legal issues like data privacy and liability. Moving to the quantitative analysis, our sensitivity study shows that for both alternatives, revenue volatility has the highest impact on net present value, while Alternative B is more affected by capital investment and economic life. This suggests that for Alternative A, we must focus on market penetration and pricing strategies, while for Alternative B, careful capital planning is crucial. Lastly, the probability analysis reveals a trade-off. Alternative A offers a higher expected NPV of $80.4 billion, but with a larger standard deviation, indicating higher risks and greater variability. In contrast, Alternative B shows a lower expected NPV of $25.4 billion, but a tighter range, reflecting more stable but modest returns. In summary, Alternative A is a high-risk, high-reward option driven by market success, while Alternative B is lower risk, but with limited upside potential. These insights inform Tesla's decision-making and highlight the importance of targeted risk management strategies for each model.
My name is Sargon. I'll be presenting the recommendations part. So, from going and analyzing and doing the research based on alternative A and B, we would proceed with development A, as it's a way better model. It offers superior profit, shorter payback period, so you make your money back and everything in an earlier period than waiting over a long period. And it's more like viable as an initial investment. And also organizing and maximizing efficiency, as it's cost effective, doesn't cost as much compared to alternative B. The only issue is having to have factories, infrastructures like the gigafactories, and the integration of the AI softwares, and the battery technology as well, in order to produce a certain amount of the robots. And the rollout strategy. So you've got to have a strategy in order to produce a large amount of them in a certain time period, as they could take a bit long to produce. So some recommendations are to start with alternative A to gain some industrial traction, then use the financial gains and technical learnings to fund and develop a more advanced product for model number B.